All right, everybody. Hey, we are back with our next amazing note investing rock star. This guy, it's not often you come across somebody who's created and sold over $100 million in owner finance notes. And so
I don't know if we're there yet, but we're going to be there pretty soon.
You're pretty close. I think you're pretty close.
We're on our way.
You're on your way. Exactly. And I will tell you this, we've got a true note pro. We got Nick the Note Guy. I'm Scott the Note Guy for years. Nick the Note Guy out here, who's also a fellow Austinite here on Note Camp here. Yeah, exactly. There we go. So we're glad to have Nick here. Nick, how's your weekend going so far for you, buddy?
Good, man. It's going good. I mean, it's Sunday, but hey, I work all the time. It's not really work when you're doing what you enjoy to do. That's for sure.
Exactly. And the fact that we can do it from home, where there's having to jump on a plane, get up, up late the night before, too much adult beverages, and then go downstairs and network. It's exactly a good hour and a half here for you. But we're glad to have you speaking here at Note Camp for the first time, and hopefully as well. So
thanks for having me on. I'm excited to share some of my knowledge and experience with the viewers and the listeners wherever they might be. And I'm not a professional educator. I'm not a professional speaker. But I talk about what I do. I mean, I think that's what's really important. I actually do what I'm going to talk about today, and I've been doing it for a long time. And it may not be the right strategy for some or all, but it's worked well for me. And I know it's something that isn't very well known of, because a lot of it's we sort of brought back old school in a lot of ways. So it's hopefully it's a value to people that are going to stick around and listen to us.
Yeah, we've got investors from all across the country, even got some international flair, Canada, Australia, England, Israel join here. So yeah, and then of course the replays will go out to everybody. So we got viewers online and viewers here domestic. So just thank you so much for coming on and speaking here.
Thanks for having me.
Yeah, no problem. So I'll jump off here, but I'll be lurking with comments.
Lurking. Please chime in anytime. Don't fall asleep on me, man. I can't.
Oh no.
All right, let me. I got to fold this up, and we'll get going here. Give me 1 second. We got to go. It's a little hard doing two things at once here. Here we go. And okay, I'm going to share my screen, and we should be ready to roll. Can you see my screen okay?
Yes, sir. Perfect.
All right, let's do this. So what I'm going to talk about today is what I call the perfect note blueprint. I mean, at the end of the day, most people that are in the note business, they learn how to buy notes. They learn how to perform due diligence, but they don't really necessarily understand how to create that note from the beginning. And I'm going to take a good portion of my time today explaining exactly what that means, where I think the opportunities are, and more importantly, how we do it ourselves. So let's go to the next screen here. So as Scott said, aka Nick the Note Guy, I get to be the Note Guy because I'm older than Scott. If I pass away suddenly, Scott can take the main that.
I love that.
Until then, we'll both be note guys because that's what we are. So I've been actually in real estate since about 2001. Did everything the wrong way. There wasn't education like there is today. There wasn't what we're doing today in 2001, 20 years ago. Data wasn't readily available. Things just weren't like they are now. So we have this unique opportunity to absorb content and make decisions based on information that we're able to get at just basically a touch of a button, search of a Google, whatever it might be, YouTube. So I started a company in 2012 called Rylex Capital. And the intention of that company was to create an opportunity for home ownership to hardworking families and individuals that have been told no by the bank. Sort of stumbled across how to do that. I'm not going to really get into the backstory of it because I don't have enough time, and we got some great guests coming on after me, so I don't want to lose sight of that. But I started a company, and I started myself. But shortly after I founded it, I brought in a partner by the name of John Montero. Now, anybody that's in multifamily space now may have come across John Montero because after we sold Rylex Capital, John decided to go more into the multifamily space. I took a couple of years sabbatical away, and then I came back in, and now we'll talk about what I'm doing. So, but we built this company to sell. We didn't know if we were going to sell it. It was all around creating mortgage notes. in a seller finance capacity to non-traditional buyers that couldn't get bank financing. We built this up, and then we end up, of all things, selling it, all the capital, all the assets, and a lot of the notes, and our proprietary technologies, and everything that we had, our employees, to all people or all things, a federally chartered bank. So it's sort of interesting how they couldn't create what they weren't allowed to create notes like we could create, but they can go out and buy it, which is what they did. Then in 2019, I created USA Note Pro, which is my primary function in life today from a business perspective. And that was really to buy, sell, create, and educate regarding mortgage notes. But I emphasize create because there's just not many people that I know of, at least, and I'm fairly well connected in the space, that really understand how to create the perfect note. Banks know how to create notes because that's what they do, right? Financial institutions, Chase, Bank of America, Wells Fargo, they have internal staff, and they're regulated on how to do it. But as you'll see in the statistics as we go on, most people do not, either because they don't know how, or they're not required to because of how Dodd-Frank is written, and we'll talk about that in a second. Then in 2020, I created a sort of a spin-off company called Wholesaler Helper. So if there's any wholesalers that are on the call and are trying to figure out what the hell they're going to do next, because they haven't been able to crack that code when it shifts to a really strong buyer's market in the real estate space, this might be some valuable information for them as well. And then in 2021, I created my partner and myself, Eric Sage, created the Creative Dealmaker Academy, which it's the precursor to the note creating process, which is really how to find the deal, how to fund the deal, how to structure the deal, how to find a buyer, and then get into the note creation. So, and then where I am today is between now and hopefully the end of 2023, we'll have created just in this 18-month period, close to from our projections, $100 million in performing notes that are all done exactly how we're going to talk about today. And there's going to be an opportunity for those that are note buyers to participate, maybe be in a fund, if you have a retirement account. We can talk about that as we go along. If you have any questions, you can surely reach out as well. Like I said before, I've done about 800 creative deals personally. When I say personally, I mean my name is on the closing documents. Okay, that's just my deal flow itself. 1,100 transactions, probably way more than that, and who knows how many countless other thousands of just from consulting and whatnot. So, why should anybody listen to me? I don't do this very often unless it's a situation like this. I'm not on the circuit, per se, but you may have seen me on or heard me on podcasts or from the front of the stage in events on either the real estate or the note side. I've written some publications, but anyway, Google me, listen to me. You like what I say, great. If you don't like what I say, great. I don't really care. This is really about me sharing with you on exactly what I do, why I do it, and how I do it. So who is this information for? And I want to get in the nuts of it. If you're a wholesaler, you probably should listen to what we're talking about here. If you're a note investor, which I think a lot of people are, either aspire to be or currently are, there's something that's going to be of value there. If you're a landlord, this is a great opportunity because landlords it's in their DNA about cash flow. Well, a lot of people don't know that you can obtain cash flow by controlling versus owning real estate, which is exactly what the banks do. But we don't really think about it that way. And I always joke around with all my friends that are landlords. And I always joke about it. I go, the reason why you're a landlord is because you haven't figured out how to be a landlord yet, right? You haven't figured out how to control without owning. And, you can make the depreciation argument all you want, but I sure like amortization probably more than depreciation in single family. And this is what we're talking about today. We're talking about single family home ownership. If I wanted depreciation or I wanted to do something else, I do some kind of a commercial transaction, multifamily storage, something like that. That's what it's good for. But single family, I'm a note guy. I don't do anything else but notes and single family. If you're an IRA, if you're a lender or an IRA investor and you're trying to deploy capital, work with a lot of family offices where it's about asset preservation, something to probably look and listen to if you're that's one of the focuses that you have. All right. Fix and flippers. It's getting tough if you're a fix and flip guy, because now instead of fix and flipping and selling it to a retail buyer, you could probably fix and flip and sell it to an owner finance buyer, still stay in the deal and hold the note for cash flow instead of treating it as a transactional model. And we work with a lot of those types of investors as well. All right. So first thing I want to ask is why you should ask yourself why you should create a perfect note. And I just call it a perfect note because it's the opposite of what most notes are created. And we'll talk about that here in a second. So that's one question we're going to ask and answer. And then another question we're going to talk about is how big is the seller carry market? Okay. Well, I think let's just start with that. So the seller carry market is about $27 billion. Okay. That's all mortgages that are written that don't have the name of Wells Fargo, Chase, Bank of America on. Okay. It's a substantial number. A lot of people don't even know that this market exists. I would imagine a good portion of the people that are listening today that have some experience in notes may have some understanding of this. But over the last 4 years, we're talking over $100 billion in seller created paper. Now, what's interesting about this paper and what people don't really talk about is the quality of the paper, okay? The quality of the seller financing paper. We talk about how it's a $27 billion, it was $27 billion in 2021. The number is going to only go up moving forward because banks have tightened up their requirements for underwriting. Rates have gone up. There's not nearly the gap any longer between getting a traditional mortgage and providing seller financing to a buyer. So that's a big factor. But 90% of that paper, and anybody that's can probably attest to this, that's actually bought somebody else's notes before, can attest to how the flaws and the errors, and there's omissions of documentation. It's not written illegally. It's just not written with best business practices in mind, how a bank would do it. Okay. Then we're going to talk about that as little. So 90% is what I would call flawed paper. It's called scratch and dent, which causes the discount that sellers of notes have to take, that we are taught as note buyers to look for to create the value proposition to get the yield up or whatever it is we're looking for. But really, most people would prefer a high quality, brand new note that there's no scratches and dents on whatsoever. So I'm going to talk about how we can create that or how you can even buy it. Okay. So why is the seller carry market so big? And this is another question I always wanted to know the answer to, because $27 billion, it's not a small number. It's a fairly large number that not many people even know about. Well, there's two reasons I attribute the seller carry market to be so big. One, 60 to 70%, depending on where you get your news and your data from, borrowers can't qualify for a traditional mortgage. They fail to check all the boxes, what I call a pretty buyer, where they don't meet the DTI requirement, which that the income, the credit score is not right. They haven't been in their job long enough. They don't have the proper down payment. One of those factors will disqualify them, and 60 to 70% of the buyer pool cannot qualify. No one ever talks about this. Okay. But it's a huge, huge number. But now we're going to see why this is important. And if you're a seller of property, why this is important when you start struggling to get your asking price when you sell, by being able to provide seller financing is a tremendous opportunity to get your price and get value out of creating a note on behalf of a buyer directly. The other thing is in this example or in this model is that less than 5% of all the properties that are available for sale in any market are even available to purchase with owner financing. Okay. So out of 100, so let's look at the economics of this, because this is really important. If there's 100 properties available in the market for sale, only five or less than 5% of them are available on terms. Well, if 60% of those buyers that are looking need financing, it seems to me, and I wasn't great in math and I wasn't really good at, in school, but I did understand the basic concepts of economics 101, supply and demand. If you have supply and it's in high demand, you're controlling the hammer. And if you have the inverse of that as well. So you have the unique opportunity to control both sides of this equation. You can provide seller financing to the 60%, 70% they can't go get a bank loan, and you can provide properties for them to buy where only 5% of the marketplace even allows it. So that's what makes this market so valuable and even more valuable moving forward. So this information comes from Advanced Data, which is Scott Arpin and Tracy Rui at Known Investing Tools. Thanks to both of them for providing some of this data and content. I just want to share some visuals on this. I'm in the Texas market. Even if I was in anywhere else, I would only do deals in Texas personally. It's just the best place to do deals. I mean, no one's leaving Texas going to California, not anytime soon. Okay, that could change. But Texas is a great market. That's why it's a large percentage of the seller carry market. Note buyers want to buy in Texas. People want to live in Texas. Other states too, but it's a very, very popular market and if you have a note that you're looking to buy and or sell, and it's in a desirable area, you're going to have to either pay a premium or you're going to get a premium price for it. Okay. Other states are good too. We do stuff in those other states as well.
Just Texas is best. Don't mess with Texas, baby.
Yeah, I know. I know. I say that it's funny when you say that. I always think when they say don't mess with Texas, I really think they mean don't mess with Texas banks or Texas lenders, because you do not win, you do not beat the Texas lenders and banks in the state of Texas.
Oh, that's the truth.
That is a true statement. You're gonna get what you get coming back. So I only want to show this graph visually because if it starts in 2009 and goes to 2021, but as you can see, starting it was a gradual growth up. And reason being, in my opinion, is because banks got really tight on, they got their hands slapped in 2008 and their underlying guidelines got really tight. So people couldn't go get a traditional mortgage. And that started this trend going up. As we got into 2014 and 15, it started sliding down. And I don't think that seller financing went away. What I think that we started to see is that we started to have sellers could be more picky on who they could sell to. They weren't even necessarily selling to retail buyers. This is when hedge funds started coming in. iBuyers, things along those lines started really hitting the market and overpaying for properties and made it quote unquote easier for the seller to sell without doing a whole lot of heavy lifting. That's starting to change. And that's what we're going to see as we get into 2021. And we look out a few more years, this graph will continue to grow. But the overall number has not really declined as far as the revenue side of it goes. Just another couple things on statistics. I'm sort of a stat nerd. Residential makes up about 53% of all the seller carry. A lot of people don't even know that you can owner finance land or owner finance commercial properties. Heck, before 1990, almost everything was transacted this way, and banks got a little bit wise to it, and they found it was better to reset the mortgage and have somebody requalify. So these are just some of the statistics here. Just another slide here. I want to point out in 2017, we were about almost 8 billion in seller carry volume. In 2021, we're almost 15. Hasn't quite doubled. It'll probably be doubled by next year. Why is that? Well, to think the same reasons we said, it's a substantial part of the industry, which is where most of the people's notes come from that look to buy notes. So we want to talk about those here. So another stat I just want to show, this shows LTV about 77%. But what I thought was interesting on this slide, that year over year, it had gone up 49% in the value, meaning in this slide here shows $269,000. That seems awful high to me. I don't have a way to verify this data, but that tells me that people are getting more and more comfortable with seller financing as an option. 5-10 years ago, the houses that were sold on seller financing were beater houses, man. They were stuff that would never pass an FHA inspection. You couldn't get a mortgage on them because either the value was too low, something along those lines. But now we're seeing really nice properties turning into seller financing. I think landlords are getting smarter, and they're going, well, heck, I can get the same amount of net cash flow, if not more, by becoming the bank versus being a landlord, and they're okay doing so. This is an interesting slide here because this is where I really want to start diving into. That over the last 12 months, and this number has actually gone up, that only 84% of all notes that are created are one note creators. Okay, and let's talk about this for a second. When I say that is that they're probably mom and pop note writers that have no experience in writing notes, no experience in underwriting. And as a result, you have inferior files and collateral files that are that have a lot of holes in them, which it's one thing to negotiate the risk, to negotiate the price based on risk, but it's another thing not to have an accurate file. And the biggest thing I see personally in this 84% is that since Dodd-Frank, anybody can write just one and not have to really abide by any of the Dodd-Frank requirements or rules. I think that's highly foolish, in my opinion. I would never tell anybody to write a note without doing an underwriting the buyer, have an RMLO do that process. It's just too important relative to just a lot of different things, especially note value. But most of these notes that we see, that's what's happening, is they're not professionally underwritten, A, because they don't know how to, or B, because it's not required. So it's a big number. And that's the kind of paper that most people that are looking at buying notes have to determine if it's worth buying or not, and trying to assess the risk. That's very subjectively, it's very subjective. When you have a fully stacked underwriting file, it's a very objective process on the value, because all the boxes are checked, T's are crossed, I's are dotted, and it's a very well written note and a very well stacked file. And we're going to show that here in a second. There again, I just to sort of recap on it, just shows a little bit of how some of the volumes, it's fluctuated. And, it's around 15% of all the notes are written what I would call by professionals, pros, which is what we fall into and how we teach other people to do it. But that doesn't mean they're always doing it the correct way either, because I know this for a fact, because we consult with them, people that have written 50, 100 notes, and there's just mistakes all in it. And really important. The reason why I learned all this, how come I found all this out, because when we were selling Rilex Capital, they were basically ripping across our file folders, and all their notes are written, and they were telling us what we did right and what we didn't do right. And we were able to make those changes and adjustments, because we probably wrote 500 notes where I would say they weren't correctly, they were poorly written relative to how they're written today. So, your ability to learn from this, I think, is extremely valuable if you're really going to get into that, either buying a note or creating a note. So let's continue on. So, I want to talk a little bit about what is being the bank, because you may have a lot of people on this call that just say, hey, notes sound cool. I saw something, on a video, and I thought, let's check it out. Well, being the bank is just control versus owner, right? It's what banks do, right? Banks learned a long time ago, hey, let's control, not own. Banks don't really own anything, not intentionally at least. It's about amortization versus depreciation. It's a secured asset. Well, sometimes you have secured assets and other things. It's about being a lien lord, not a landlord, okay? So why be the bank? Well, we talked about that a little bit already, but the couple of things that I like about being the bank, it just gives you more options. And if you have the ability, a lot of people think creating a note and being the bank is hard. It's really not. I would argue that if you have the right systems and processes in place, it's easier to do the original trading yourself than it ever is to go buy a note and try to underwrite and review every paragraph of every page of every document in an underwriting file. And I think that's where a lot of people really make a fundamental mistake, is that they sort of glaze over it. They think it looks good, the note's performing, but it ends up becoming a problem and a job, unless you're just a seasoned non-performing note specialist, which I am not, and I have no desire to have non-performing notes because I don't have to. I have high quality performing notes. Why would I want non-performing? I'm perfectly content with the yield and the consistency of what a performing note provides. The other thing is that the pretty buyer avatar is declining. We talked about that 60 or 70%. And honestly, hedge funds are going away from the sellers in a lot of different categories. And to be quite honest with you, hedge funds just don't buy everything. Hedge funds don't buy everything in secondary or tertiary markets. Hedge funds don't always buy stuff older than 1980 or less than 3 bedrooms or in a population size of under 100,000 or whatever it might be. So you have the ability to provide opportunity in the markets where hedge funds don't normally participate in. So why does this model work? So just a recap on it. Well, it's a big market. It's low risk with high yields and it's securitized. But 80% of these buyers, or 80% of renters rent because they have to, not because they want to. So when you're able to, I cannot tell you how many buyers we've sold properties to and our clients have sold properties to, where the buyer says, I've been told for years and years and years that I can't buy because I can't qualify. And that's just not true. It's just they can't qualify traditionally with the bank. These buyers are every bit as good, if not better than the borrowers that banks qualified. They just have a little bit different path to get there. Okay. So why is this important? So I want to just talk about the value proposition just for a second. Okay. So what we do with our clients is that we help them create performing seller financing notes. We recommend creating a first and a second lien for a lot of different reasons if they're creating them, because when they create a first and a second, then allows them to stay in and materially participate in the back end, but it also provides a lower investment to value to the first lien note buyer. But all this is done for you. So really think of it this way. You have to find the property, you have to analyze the deal, you have to figure out how to fund it, and you have to sell it, right? Which is no different than anything else on a real estate side of a transaction. Whether you're a wholesaler, a landlord, fix and flipper, whatever, it all starts with that. The difference is once you get to the exit and the creating of the note. Well, what we've done through USA Note Pro is that we're able to provide that opportunity to manage the transaction. And the reason why we do that is because we're note buyers, okay? So we're a note buyer and we know what the note should consist of. And that's what we like to see. So we stopped trying to, because people would send us notes all the time and we'd have to look at it, and the amount of time and energy and effort just to review a file and find out that it wasn't going to work was just painful, to be quite honest with you. So we just provide it and say, look, we'll help do this work and hold your hand and you stay out of the way. But all the documents are fully underwritten. They're Dodd-Frank compliant. They're qualified mortgages. We don't do contract for deeds. We do only mortgage deeds of trust. It's all third-party service. It's all managed in-house. We're able to control the chain of custody of the file. We're able to do mortgage post-closing quality control if need be. And then we talk about, whether you can write just one note, but to get maximum value, we've learned, and we'll talk about these ratios here in a minute. Sell the first, keep the second, keep the cash from the down payment, move on. Our note buyers are ourselves, but there's also Fortune 500 companies, banks, family offices, private equity groups, which don't like to necessarily deal with the one-offs. They want to have it in a tranche and be able to do it. And we're able to do those kind of things. So, if you have a note that you're thinking about creating, you want us to look at it and you want us to help you structure it, reach out to us. We'll give you some information on how to do it. It's extremely inexpensive. It will cost you twice as much to do it yourself. It'll cost you 5 times as much if you do it wrong. I can promise you. So let's go on to this next slide here. So the note creating process, what does that mean? Well, I just said how you find it, analyze it, fund it, and find a buyer. And then everything in the red is the stuff that's done, that can be done for you. This is where a lot of the mistakes are made. I don't write my own promissory notes. I don't write my own documents. That's what the professionals get to do. Everything's done at the title company, at the servicer, at the underwriter, with the attorneys. It's all done in a very specific package and fashion that we've already reviewed and approved. And it's just plug and play based on our criteria. So if you want to learn how to sort of maybe structure a note, if you go to cashflowdealmachine.com, you can download a copy of our it's a spreadsheet. It just shows you how to plug in information and sort of how to structure the note for maximum value. Because whether you're a note creator or a note buyer, I just want to be extremely transparent on why this is important for both parties, all parties involved. Because if you're creating and you're selling it, there's benefit to the note buyer. But if you're staying in the deal as well, in the second lien position, that benefits you because there's cash flow as the creator, but it also benefits the first lien buyer. Okay. So, and this is basically what it is. So, and when you do the perfect note, it's really a win-win-win. The note creator wins because they may not be able to sell this to a retail buyer. Maybe it can't pass an FHA inspection, for example. Well, guess what? You don't have to pass an FHA inspection. You just have to have a price that's in line with value and something that a seller and a buyer agree to do. The new homeowner wins because we already talked about that. They weren't able to buy a house to begin with, okay? Or they couldn't qualify for the house they wanted to buy. The note buyer wins because of the three items here in the yellow. They're only buying a 75% or less of the value of the property. So their investment value is lower. And we're trying to get that down closer to 70%. So it just puts them in a much better position from a risk perspective. Okay. Like I said, it's a fully underwritten buyer. We don't do CFDs. You can do a CFD if you want to do a CFD. We have no interest in them. I don't believe there's any additional protection personally with doing a CFD, but I don't do business in all 50 states, so I can't speak to that personally, but I do know this. I don't know of one bank in the United States that does loans in any of the 50 states that does a contract for deed instead of a mortgage or deed of trust. And I always said, if it's good enough for the banks, it's probably good enough for most. And that's the policy and position that I have on that. And then what I think is sort of extra value is that since we're creating a first and a second lien, okay, the note creator stays in the second lien position. And I think it's extremely valuable because the note creator has all the information, knows the property, and probably has a relationship with the buyer because they had a conversation with them, probably is local to the property, and it just keeps them in, if their majority of their profit is in the form of the cash flow from the second note. You know, I love when people are in the second lien position that have some skin in the game because it just protects my position. If I'm in the first lien position, that's only added. It's like having an additional cosigner on a loan. Heck, I'll add 3 or 4. I don't really care sometimes because the more the merrier when it comes to protecting the investment. Okay. So here's a little quick tip for anybody that's buying notes, okay, or creating notes. I call it, it's the ZHVI, which stands for Zillow Home Value Index. So go into Google and just type in ZHVI and the zip code, and you'll get a median home price, okay? And what I like about this is if I'm buying a note and I'm creating a note, I want to know what the median is. And I surely don't want to be above the median by a large percentage. I don't want to be in the upper 20 or 25 percentile of that. I want to be below it. I like to be the median or below. I'm going to show you an example what that looks like. And this example is 282,000. It also gives you the 1 year change. So this zip code has gone up 27% in the last 12 months. Now, that is going to definitely change because we've already shifted away from being a uber hot seller market, starting to cool off. These numbers will change and it will start to decrease over time. But that doesn't change the difference on the value index, okay? So this could still be 282 next year, maybe be 285, but the percent change might be 3 or 5%. So why is this important? Well, let's just look at an asset for a second, okay? So in an asset that we just did, we sold it for 175. The ARV value was 215. But the median home price is 282. All right, why is that important? Well, it may not be important, but what I like to see is that I'm going to acquire an asset for $175,000 and I bought it at a 60, 70% investment to value, but the value of that neighborhood in that zip code is much higher than my property. I'm on the lower end of the spectrum, which is where exactly I would want to be in the event that I had to take a property back in the event of a default. It doesn't mean the note's going to default. Doesn't mean it's not going to perform. It's just another variable that we look at when we're creating the notes. And guess what? When we go to sell the notes, this data is there as well. Okay. So let's go on to the next one here. Let's move this out of the way because it just moved it. And I can't get
Nick, we got a couple questions I want
to
to throw in here. Yeah. So on that, Ravel asked, what was that Zillow code again?
So it's just, I'm trying to move this thing out of the way for me. Oh, let me go back. I don't think I can go back. So it's ZHVI, okay, which is this right here. So it's ZHVI and then whatever the zip code is.
Okay,
Okay.
cool.
So go to Google, just type in ZHVI, zip code 75142, and you get a little statistic report for that particular zip code. It's really helpful if you're looking at a note to buy, because in this example here, if I'm paying, if this came out and say the Zillow home index was 140, okay, and the value, because there's properties that are worth $210,000 in a medium home price neighborhood of 140. It happens all the time, right? So that's all we're saying. That's the picture that I'm looking at and showing there. So that, hopefully that answers the question. Just
Yep.
put ZH value and zip code in there in the thing. Was there any other question before I move on?
Yeah, Vicky asked a question. So the note creator stays in the second lien position. How did the seller become to be in the second position? What am I missing? Vicky, they're creating a first and a second. So like an 80% first and a 20% second, or a 15% second.
I
or
think it's
10%.
on the next slide. Let's go to the next slide and see if it shows you there, because that's a great
All
question.
right, cool.
If not, I'll try to break it down. All right, let's see here. Okay, yeah, I think, yeah. So yeah, well, it doesn't show it on here specifically. So this is sort of the summary on it, right? So this sold it for 175, got $15,000 down. So the down payment gets kept by the creator, right? This is the note creator side. Seller finance, this particular one was done at a 75% first. So 132 of 175 is the first lien note value. The difference, which doesn't show up on here, we can do the math on it real quick. 132 plus 15 is 147. So what's that? A $28,000 second note. Okay. So the seller, the note creator, stays in this deal with a $28,000 note because they sold the first off at a 75%. So this situation, they got 8.6% down. They wrote a 75% first. So that turns out to be what, about what does that come out to be? 17%, give or take, 17,
Yep.
16, 17% second. Okay. So let's break this down for a second. So the note buyer that's going to buy the first lien wins because they bought a $132,000 note at a 9.5% coupon for 128 in this example against a property that's worth $215,000. Okay. Against the market median home price of 282. I like my chances as a note buyer if I can get that quality of a note. Now there's a premium with that, but I get, a lot of people want the convenience of the known quantity. I know that's what I do. That's why we write it. So in this situation, the investment to value is 64% for the buyer. I don't have the second lien on there. I think I had it on there and I took it off. But in this situation, the net cash on this deal, it might be actually on the next slide, was probably $5,000 or $6,000 plus the free and clear second note. It's a great model. I mean, because it takes you out of the risk perspective. If you're going to be creating and you end up with if you're a creator, you end up with a bunch of free and clear second notes or very little investment to get a very, very large second note. And the first lien holder wins because he's buying it at such a low investment to value. Whereas if you write it for a big, large first lien, the discount you're going to have to take is going to wipe out the majority of the profit. That's why we don't recommend doing it. And I rather defer it because I know that the note's going to likely perform if we underwrite it and structure it correctly. Any other questions on that? I think we'll get a little bit more when we go to the underwriting, but I want to make sure before we move on, I don't miss something on that. We good?
Vicky asked if you're in a second lien position and the bar stops paying you, do you still have the right to foreclose subject to the first? Yeah.
As always, 100%. And we're going to talk about how that's a great question. And when we get to the underwriting side of this, I'm going to show you and tell you what we do and how I do it, sort of gives us an extra couple layers of protection on that. So let's go on here. So I got to go back to the screen. All right. So let's do a quick little recap. Okay. If you're a wholesaler, realtor, fix and flipper, landlord, private money lender, IRA note investor, you can be on either side of the fence on this. You can either be a creator or a buyer. Okay. We also buy notes too. And what we do, and we work with people so that people can do it. If they follow the protocol, we become a buyer as a result of following it. But if you bring me a note or bring us a note and it wasn't followed the protocol and system and process we recommend, we will likely not be a buyer because we would probably make you an offer or indicative bid, but it's probably going to be at a very low price because we're going to go fix it to make it look like we want it to look like. Okay. So, so let's talk about structuring the deal real quick here. Okay. Oh, before that, let's get into the numbers. Okay. So this comes from PaperStack. Let me know what PaperStack is. It's a great platform if you're looking to buy or sell, but I love other people's numbers because I can just leverage and put them up against what we're actually doing ourselves. So as we get into this, I want to point out a couple things from their report. Okay. And I highlight them in yellow. I'm just going to go with the first one. So the first one talks about performing versus non-performing. Of all the assets that sold on their platform, 74% of assets sold were performing. Well, it gets back to the supply and demand piece. Well, I want to be on the side. I want to be able to sell something that's performing. Okay. Well, brand new note by definition is not performing. So I guess it's technically performing, but it's not non-performing. I know that for sure. The other thing I like is that here and going to the left to right, all the notes that are sold were first position notes, 84%. So all the notes that were sold were 84%. Now, does that mean there wasn't that many second liens on the note on the platform? Maybe not, but just objectively looking at it, first lien positions are more valuable and desirable than second. That's why I have no problem keeping the second and selling the first, because I don't have to discount it. Because if you discount it, you lose all your profit on the second note. Going down here, another statistic I think is just very, very valuable. Mortgage note versus contract for deeds. Okay. 78% were sold were mortgage notes. Now, there again, I don't know if that was that high because there's just that many more mortgage notes versus contract for deeds. But I do know that more contract for deeds are deeply penalized by most sophisticated note buyers relative to mortgage notes. Okay. Does it mean it should be? I don't know, but that's just a statement of fact. And the last thing in here, most assets are sold in single assets versus pool. And the main reason is because most people either A, don't have enough assets to create the notes on, or B, they don't have time on their sides to build a big enough portfolio to sell them in a pool. Okay. Which is hence the problem is that most note buyers, to get you maximum value, are going to want to have a large tranche of notes to take down because they can't deal with a bunch of $150,000 notes. It's not efficient for them to do. Okay, let's go to the next slide. Let's see. So why create the perfect note? And I think this is where I want to spend all the time on. What we see from our experience and our track record, that our note sales average 90% or above of UPB. So if you believe what the PaperStack numbers to be accurate, they were 82 to 84%, depending on which number you're looking at. We're well above 90. So just by creating it the right way and following better business practices, the note value that you're going to get back on the sale is going to be somewhere in the 8 to 10% higher than the average. Okay. So what does that mean? Well, if you're going to create $1 million worth of notes, that would end up netting you about an extra $80,000 to your bottom line. It's significant. It's not that hard to go do 6 or 7 $150,000 notes. Not anymore. It's not. It's there. And so, but that's what's going to get you the max value. And you do, and there's a lot of other factors. And I use the analogy. I'm in Texas. I call it my Ford F-150 example. So, you have two white Ford F-150s with 50,000 miles. They both were built in 2015, and they're white with tan interior. But one of them has perfect maintenance records. There's not a scratch or ding on it. It's in pristine condition. The other one looks like it's been through a tornado. The seats are torn up. There's no records. The tires are bald. The brakes don't work. There's not an inch of paint that's not scratched, dinged, or damaged. Which one of those is worth more money? Okay. Doesn't mean that you can't buy the beat up one for a better price and fix it and maybe end up in a better position in the long run. But that's not what most note buyers truly want. They want something that's going to perform and move and be dependable. That's what I've seen from my experience of doing this. They don't want to have to mess around with a non-performing note. Okay. Non-performing notes are work. Okay. Doesn't mean everything that we write is going to perform. Absolutely not. But I like our chances a lot better when we've done all the things that are necessary to give us the best chance of obtaining long-term cash flow through a performing note. Okay. Because that's exactly what the banks want. The funds want, the private equity groups, the family offices want. They don't want to mess around with anything. They want to deal with a predictable return, and they're willing to pay a premium for it and even take a little bit less of a yield on it, knowing that they don't have to mess around with it, because all those things cost them time and money and velocity. So how do you create the perfect note? Okay. Well, I think that's what I want to spend a few minutes doing here. The good news is, I'm going to go back to this other slide, is that you're better off not doing it. You're trying to do it yourself, but let somebody that has the expertise and experience do it for you. Okay. You're going to have to pay somebody to do something anyway. So at least, because here's what happens. Okay. You have a title company and you have the attorney create the promissory notes, for example. Okay. But they write it from a legal perspective. They don't write it from a bank's perspective or a note holder's perspective. Well, there's a lot of things that you can integrate into that verbiage of those notes that gives you extra layers of protection as you go on. Okay. But we talked about the ability to fully underwrite the buyer. I think Dodd-Frank and the RMLO is extremely important. We're going to talk about that here in a second, and so on. So just know that there's a place that you can go to have somebody manage the transaction if you choose to, if you really are seeking not only the maximum price if you want to sell it, but if you also want to stay in the deal long term. And it also just the legal protection of it too. A lot of people make mistakes in the creating of the paperwork, and once that borrower signs those closing documents, you cannot go back and fix some things. Okay. So this is it. The orange stuff is what you're done it. The bottom stuff is what we can help you do if you choose to. And if not, at least get a copy of we'll provide everybody a copy of a redacted file of all the documents and stuff that's in it, Scott. If they can just reach back out to us, we'll give them permission. I'd be happy to provide that to them so they can, if they really want to go look and create it and see what's in it. I'm really more about education first, to be able to get them to create the notes the correct way. Awesome. Did you have something? Okay, good. So some of the things that gets done that most people neglect, these are just high level stuff. They don't put all the required documents. They don't use an RMLO. They don't do disclosures. For example here, there's probably 25 to 30 disclosures in a properly underwritten borrower file. And I can promise you, on the files that I look at that don't use RMLO, the disclosures do not exist. And those disclosures are there for a very specific reason. Because when Dodd-Frank was written, they wrote it, well, it's debatable, but it was really to protect the borrower, so they say. Maybe they did, maybe they didn't, but let's assume that that's the reason they did it. Well, when a borrower goes through and they put their name and they sign on 25, 30 disclosures, in my opinion, that's protecting me as the creator of the note, because of all the stuff that's in that file that adds another layer of security for us in the event that anything ever materializes down the road. Okay. We always use a third-party servicing company. Very important for a lot of different reasons. Couple highlights on there is that when we write the promissory note with two liens, it's one payment letter and it goes to one servicer, and there's only one servicing fee, and it gets applied accordingly through the paperwork. And what's nice about that is that as long as the buyer of the first lien leaves it with that servicer, it's very effective in keeping everything performing, and protects the second lien note holder as well. Now, there's always times that we sell it and they want to self-service. That's great, but and we'll cross those bridges when we get to them. But in the beginning, we want everything going in. The borrower's making one payment. We always escrow taxes and insurance. It's never an option. And then what's nice about it, when it comes into the servicer, then they distribute the funds as dictated per the agreement to the first lien holder, second lien holder, access the escrows and of insurance and taxes as well. We always get a lender title policy as well, and that's a lot of things I see missing in a lot of collateral files. That there is no lender title policy. You can always add a lender title policy. It's extremely expensive to add a lender title policy after the fact, but most people, they don't, out of sight, out of mind. If they don't see it and it's not on their checklist, a lot of times it gets missed when they buy the note, and that and hence can cause an issue later down the road. Okay, some other documents: mortgage deed of trust, document checklist, all the due diligence collateral files, all the verbiage that goes in the notes, the payment letters, how the servicing is structured, disclosures, and how we write the disclosures, how we write insurance, borrower insurance. One of the things that we like to do is we list the servicer as our mortgagee on the insurance policy. The reason why we do it is, one, they have a fiduciary responsibility to us anyway. Two, that's their job to manage that. But three is that when we turn around and sell that first lien to a new note buyer, we don't have to necessarily go back in and change it, which is extremely, time consuming and an issue. You have to have the borrower go and update that. And just, we try to eliminate that stuff in the beginning. Same thing with our trustee. We make sure that whoever's listed on the note as a trustee is somebody that can handle a foreclosure trustee, a foreclosure in the event of that happening. We want to have that already done in the beginning. You can always change it. We always want to focus on getting it best as possible from the very beginning. And these are all approved docs that I personally approved, that I've done from years and years and years, and they're all there. Now they'll be different for different states, but conceptually they're all relatively the same. So this is just an example of all the documents that you should be looking at. I didn't have enough room to put them on one side, and I really honestly didn't want to break them down any deeper. There's a lot of documents. There's buy-side documents. When the property is bought, we like to see those in there. We have no problem disclosing them, because if you're going to stay in the deal in a second lien position, you may need to go back to those at some point in time. You may need to see a owner title policy. The reason why we put them in there when we sell is that they're really not that important to the transaction. But what we've learned over time, it's inevitable that somebody wants something from before, and they inevitably ask a question. When people ask questions, it takes time, because you got to go look and try to figure out where they all were. So by just providing everything from the very beginning to the note buyer, it just makes things a lot cleaner from the very beginning. A couple of the highlights on here, I think I already addressed them, two of them at least. The RMLO package, extremely important to go through that. When it goes in the transaction management system and it's being done for you, the RMLO is set up on your behalf with the buyer and the RMLO to get the documents created. So you're not going out and trying to find that RMLO to do that underwriting for you. Proof of buyer's insurance. I think we talked about that. We just on there, we make sure we list I list the servicer as my mortgagee on it. And the other thing that we put in a lot of stuff when we sell this property, we do it. We highly recommend it. And a lot of people don't do it. We always try to put a right of first refusal to buy that property back if that buyer decides to sell at some point in the future. Because if I have an opportunity to get that property back, and it's a really good owner finance top property, I have the ability to buy it. I can have it, buy it back, and I can recreate the process, because properties are hard to find, at least the ones that you want that you've already done the work on. If you already fixed it, for example, you're a fix and flipper and you already fixed it once 3 years ago, and you already know what you did. Nice to come back and buy a property that you already have. We can put those terms in there as well, file it with the closing documents, record it, and have that on there. It doesn't mean you're going to buy the property back. It doesn't mean the seller has to sell it to you. It's just one more thing that allows you to look at it. And then on the note sale side, all the purchase plus all the other documents on the buying side that go in that note sale package, purchase sales agreement, the collateral assignments, transfer docs, and allonges. That's all part of this process too. So if you choose to use this to do the transaction management, you get the management of all this, the creating of all the documents, the archive of all the documents, and then also the facilitation of the closings for both the selling of the property to the borrower as well as the selling of the note if you decide to sell it. So pretty valuable stuff in my opinion. I don't get any complaints on it. And it's, like I said, it's probably twice as cheap as if you try to do it yourself, five times more valuable if you screw it up instead. So let's go. I think we're about done here. Selling
We
a
got a few
note.
more minutes. We got a few. We're good. We got a few
So
questions I'm
selling
going
a
to ask
note,
you here.
the key to this is to create a premium note of value, which is the difference between the performing and the note. We already talked about the Ford F-150. This will recap. We want all our first liens to be under a 75% first lien percentage. If you download that modeling software, it defaults in there, and you can show right away before you even decide to go in to create a note that, maybe if it really makes sense or not to structure it, or how you need to adjust it so it does either on the buy side or the percentage side. I think that's probably close. Oh, yeah. So if you want, you can scan this code here. You can scan it. That'll get you in. You can register, and then they'll send you a copy of the deal analyzer, or you can go directly. You'll get a copy of the $4.7 trillion secret. So if you're doing that's more on the IRA side. So if you're doing anything relative to the IRAs, might be something of value to you. We also do have a private Facebook group where we talk about the creating side of it, the front end of it, which is finding the deal, analyzing the deal, funding the deal, and then finding the seller finance buyer before you take it over to transaction management. That's what the Facebook group does. We go live once a week. You can it's free. You just join if you want to. You can also join our note buyers list if that's something that you're interested in learning more about the notes that we have available. Most of the notes we have pre-sold, or they're sold fairly close to after we create them. If you need to reach out to me directly, you can do so through the website USA Note Pro, or directly here at Nick at USA Note Pro. And that is, I think, all of it, Scott. So hopefully there's some questions. Hopefully we have, some things that we can go back and share. I'm going to stop sharing my screen real quick.
Keep that up a little bit.
Oh yeah. Okay. Let me go back. Yeah, go back.
Yeah, keep it up for a little bit for folks.
All right. Let me share it. There you go. Cool.
All right. So we got a couple of questions. Somebody asked, so when you set it up, the service, do you own the servicing company as well? Who are you using for service?
No, I do not. Well, it depends, right? Because we do stuff, all 50 states. I primarily use August REI in the state of Texas. I don't have any interest in that company other than that they have the majority of the notes on the platform. When I started using them, they had probably 600 or 700 notes on there. And now between myself and the notes that we've sent their way through relationships, several thousands of notes, and I think they have 6 or 7 on their platform now. But what's nice about it when it comes through this process, everything's treated as it was ours. So we have a very specific process that they follow relative to the way we structure it. That goes with the title company, that goes with the servicers, that goes with the RMLOs as well. We use our title companies, we use our attorneys, we use our documentation. If everybody's more than willing to use whatever they want to use. It's just, I'm just going to tell you right now, we will likely not be a buyer for any of that note paper. I've been there and I've done it. It's just like it's like gun safety, right? I can give you the gun, but if you don't have the right safety to do it, you're just going to end up, shooting yourself in the foot or something. And I just don't want that to happen, to be quite honest with you. The notes that we write have been bought by financial institutions. Hell, the company was bought by a bank. Can you write them a different way? Absolutely. I just know that our model works, and most people are extremely satisfied with it. The note buyers like the paper because they don't have to screw around with a bunch of, stuff that's missing or not compliant, or a note that doesn't perform at the end of the day.
Well, it's literally written like a bank. I mean, it's written like a bank loan with all the disclosures. A lot of people try to get away without doing a lot of stuff, and it's clean, well written. Everything's dotted and crossed and tied up.
A lot of energy and effort to do it the right way. I'm telling you right now.
Yeah, exactly.
It takes a lot of energy and effort, and as much as I hate that part of the process, it's just a necessary evil if this is the business that you want to be in long term. The way I look at it is this: it's a small price to pay for something that has up to a 30-year life. You know, you're doing something that's going to get you're going to get the benefit for potentially 30 years. So I want to spend the time and build it right from the foundation up so that it withstands the test of time as best as possible.
So we got a question here. Jay is probably new to notes. He says, how would you help if I want to convert an investment property from a mortgage note to a seller finance? Is there an advantage to the seller? And Jay, I think we need a little bit more information on it. If you've got already a note
investment property, or is it a note that he already has? Like that's what
well, it sounds like he's got an investment property with a traditional mortgage on it, and he wants to. I mean, you'd have to either cash it out, or you do a wraparound mortgage, so do a sub 2 deal on stuff like that. But it's we need probably a little bit more information to answer that question.
Yeah. So I'm going to put in the chat real quick. I think I went by it, but if you go to Creative Deal Maker, I'm just typing it right now, maker.com/video. There's an example of a video on it was very similar to that. So we get asked all the time, because there's a lot of people that like to do sub 2 wrap transactions, and I'm not opposed to them, and we do them all the time. But what I teach and what I tell people, it doesn't matter how you acquire. You can acquire it with hard money, cash, line of credit, seller financing, sub 2, whatever it is, it doesn't matter. But when you go to exit, it's always the same. I mean, the creation of the exit is always the same. I always write a first and a second lien. Always. Even if I'm doing any of that stuff, even if I plan on staying in that forever, I always write a first and second, because I want to give myself the option that if I need to liquidate for some reason, I don't have to liquidate. I can always sell the first and the second together as one note, but I might not need all of it, because amortization is a very powerful tool. And if you can even hold on to 25% of the deal in the form of the second and sell the first and pay off the underlying debt, why would you not do that? I mean, that's the whole point, because I've done the math too many times, Scott. I just consulted with somebody not that long ago. They go, well, the buyer gave me so much down payment that I didn't want to, he only wrote one mortgage, and he didn't do what we told him to do. And he only wrote one. I go, why did you only write one mortgage? He goes, because the second would have only been $10,000. I go, but you understand, by not writing it, you took a $9,000 discount, because the investment, the value and the risk was much higher for the note buyer. Would you rather have had $1,000 more cash, or would you rather just had $1,000 invested to obtain a $10,000 second lien? Because $1,000 on a $10,000 second lien you're gonna get all your money back in months. Plus, you get the back end, and the face value of the note is actually much greater than what it actually is. The face value might say 10, but if it goes it goes full term, it's 3x minimum. Yep. It's a $30,000 thing. So you do not want to discount any more than you have to.
And I think so many people struggle with it. They don't, most people don't talk about that. And I'm like, you got to do that, because you're going to take the discount. This is why you don't write a first for 95, because you're going to take a discount off of, being at that spot there. First lien, well, and I give you 75, 80 cents of the value. Well, it means you're taking a 16% discount. Whereas you don't if you just wrote a second and held the second for cash flow. You know what I mean?
Yes. Well, that's what that model does. It shows that in there for you, so you can visually see it. Because I learned this a long time ago. I literally wrote 500 notes, Scott, and it probably cost me $6 million by the way that they were structured and the way I exited out of them. Yeah. I didn't lose $6 million. It cost me, and that's face value, $6 million. I mean, in perpetuity, it could have been 15, 20, $18 million.
Let's not even talk about it. So
I know,
depressing me already.
My loss is your gain. That's why we do it. That's why we do it. And, it's really the point. We're really trying to find the point of optimality where it's the win-win-win for everybody involved. And for me, creating the note and exiting out, this is what it gets you to. And note buyers have no problem paying a premium for a high quality paper that they can set and forget. Bottom line, they'll do it all day long.
Yeah,
So,
exactly.
all
What's
right.
the website again for the
Yeah.
the
So
modeling
just go to, if
software?
you go to Facebook and you should go to groups and you search Creative Dealmaker, you can find it. If you scan, if you go and you scan the code, you can get that too, but, it's there. Go to Creative Dealmaker, search it in the Facebook group and join the group. We got about 4,000 people in the Facebook group right now. So, and it's only specifically about the front end of the transaction. And we do talk about note structure and why we structure it that way. Because it's a look, I'm going to be honest with you. I'm a little bit selfish with this because I get the opportunity to look at really high quality notes that are created. It's a win-win. I show you how to do it the right way so I can buy it, but it's a win-win. Everybody wins. If I don't hold it long-term and I want to sell it off, then whoever that note buyer is gets the benefit of a highly qualified created note. And there's not anything that anybody loses, in my opinion, in the model. So that's why we do it.
So
Cool.
T Miller, yeah, he goes on. He goes, I had a client come to me to enforce a note in foreclosure. And I come to find out after reading the note on the mortgage agreement that the thing is completely unenforceable under the law, or that they let the borrower's attorney prepare the note. And it's essentially full of exculpatory clauses that prevent enforcement.
Yeah, it's not a problem until it's a problem, Scott. I mean, that's the bottom line. Look, I can drive down the freeway 100 miles an hour without a seatbelt on, and it's not a problem unless I get in an accident, right? Well, guess what? I'm not taking any chances as much. I mean, I could still get hurt with a seatbelt on. Don't get me wrong, but I like my chances of being less injured by being prepared and having it. And that's what we ultimately try to do when we create these notes from the beginning, and put the best business practice in place and really think, act, and be a bank. And when I say that, I mean it literally to the point of how they underwrite a buyer and how they approve a borrower. It's just the right thing to do. And there's a lot of paperwork, man. Our files are really deep, but when we teach and educate note buyers, they only have to look at it one time and they understand it's the same. If it's always the same thing every single time, it makes the process extremely easy to replicate. And more importantly, it makes it super easy for the people that are going to end up being the note buyers once they know, like, and trust you that you have built this high quality, high grade note that they're ultimately after.
Yeah, I totally agree with that. It's better to a little insurance on the front end goes a long way. And I like to use it now instead of getting a wreck. I mean, if you can drive on the highway with no insurance, it's all about when you do get in a wreck and bump into somebody that you need the insurance to make sure it's too late to have it then.
Yeah, exactly.
Allison asked, when does the Facebook group meet? Do you have regular meetings?
Typically we do that. We do office hours live, Eric, Sage, and myself. We usually do it on Mondays at 1 p.m. Central Time. And it usually goes about 90 minutes. We stream, it's a Zoom, register for it. We have everybody on it. We bring questions in. We go through deal or no deal analysis. We look at structure. We also stream it live on Facebook. And then once you're in the Facebook group, if you're unable to attend, you can go back and watch the replays inside a Facebook group. It's really good. Even if it doesn't matter where you're at in the note process. If you're looking to create, it's great. If you're looking to buy, it's better because now you know exactly what's happening. Everything's done on how to buy notes. Well, if you're going to buy a note, then you need to know really how to create the note as a result because people are looking for it. So we get great, attendance and participation. It's up almost 4,000 people now. It's not even a year old since we started it. And I think it provides great value and really a sense of direction because it's exactly what I do every single day. And there's no fluff inside of it.
Yeah, exactly. I agree there. So those that you guys have trouble, it's basically looking for the Zillow value, ZVHI, and then put a zip code in there. Yep. And it'll pop up easy. I just tried ZVHI plus a zip code that you're looking for.
ZHVI.
Zillow Home Value Index. I'm sorry. Yeah, exactly.
ZHVI and the zip code, and it'll pop that up. Yeah. Just a cool little tool that you can use to see where you are relative to the market. Because, people buy notes all over the country, right? There's, doctors in California are looking to buy notes in Cincinnati, Ohio, and they've never even been to Ohio. Well, this is just one more piece of data that helps you make the best decision possible. Does it mean your note's gonna be great and perform? No, but I like data, I like information, and I can make a decision, much more informed decision with more facts that I have.
That's so true. That's so true. Let's see here. I'm going back there. If that's answered.
I think it's, let me see if I can put
Let's
this
see.
in.
It says, David asks, if the servicer is the mortgagee, doesn't that mean you lose control of the mortgage?
Say that one more time, Scott.
If the servicer is the mortgagee, doesn't
No,
that
because
mean
they
you
have
lose?
no, because they have a fiduciary responsibility to me as the lender.
Yeah.
They're licensed and bonded. What's the difference? What's the difference if I send my money to escrow it at a title company? That's their responsibility, and by agreement, by law, by license. Yeah, a lot of people don't do it. I love it because guess what? I don't have to do. I don't have to manage any of it. If there's an insurance claim, guess what? They get to do all that. I don't have to mess with it, man. Who wants to mess with any of that stuff? They'll do it all. If there's a change in a policy, there's a change in anything, they get all the notifications, not me. I might be out of the country. They're going to know if there needs to be updated or insured. Now, not everybody likes it. I'm just telling you what I do and why I do it. And I've never had an issue with it. And most people don't either. So there it is.
Amen to that. I love it. Love good stuff, man. Great stuff there. Any other questions for Nick? Here, everybody, great questions. Keep asking them. Check it out. They're scan that code there for you. Vicky asked, not obligated to sell, but great free. Hang on here. We got a few folks that popped in there. Okay. So David, he already answered the partials question. I guess you weren't listening. That's why he said go to a first and a second versus doing a first and then selling a partial. You're still going to take a discount on that partial sale.
Yeah. Well, so that's a great. So let me talk a little bit about that. So you could do that, but guess what happens when you get when you partial, you lose cash flow. Cash flow is gone forever, right? I mean, not gone forever. It's gone for as long as the partial sold for, right? Whereas when I do a first and a second, okay, I may still get some cash for that, but I don't lose my cash flow because the second is the cash flow. So, yeah. It just depends on what you are ultimately after, what's important to you. Some people say, well, I'd rather just have all the money because I can invest it and make way more than 18% because I'm good at what I do. Other people are not very good at managing money and they'll spend it, right? I like cash flow. I like having a bunch of free and clear second notes that are sitting in my portfolio that I don't have any liability or debt on, and are in there and I can just let them perform. That's it. And I have other ones where I have first liens, and that's a different story because it has a different function in the portfolio, right? So it just depends on where you are and what you want to do. I always say there's more than one way to get to Chicago. You can walk, ride a bike, take a train, ride a bus. It depends. Depends on why you need to get to Chicago, when you need to get to Chicago, how much money you have to get to Chicago. And there's no right or wrong answer. It's only what's right or wrong for you at the end of the day. So this is no different. I mean, if I was 20 years younger, I might have a buy and hold portfolio, Scott, but I'm not. So that's somebody else's decision to make on whether or not they want to have a rental portfolio. I can promise you, I have no desire to own a rental portfolio at my age when I can have free and clear performing mortgage notes, or even any mortgage note that performs, and I don't have to manage any of it, because if you build the system correctly, 98% of that effort is done by the system and others, not by you.
Amen to that. That's one of the things I love about notes. Been there, done that with the fix and flips. Nobody wants to do that.
No,
it's
awesome.
Full jobs. If I guess never want to sit around waiting on somebody or getting that call at 2:00 in the afternoon on a Sunday or 2:00 at night when something's wrong with the property,
Yeah.
And the property managers. Yeah, I don't want to deal with property managers either.
I don't like people that much, Scott, to be quite honest with you. So I don't really want to talk. I don't really want to talk to anybody. I have a hard time getting along with myself.
Well, we hope to see you next weekend at the No Mastermind. We exchanged a few emails. Are you coming out?
I know I have a little bit of a travel conflict. I'm going to try to get down there for part of it. We'll talk later in the week and get you an update, but hopefully I'll get a chance to make it down there and see everybody that comes out to Austin and joins in.
Sounds good. If not, we'll definitely grab a cold beverage sometime soon.
Absolutely. All right, guys. Hope this has been valued, everybody.
Very, very much so. Thank you so much, Nick.
All right, you guys be good. Take care. Thanks, Scott.
Thanks, bud. Enjoy the rest of the weekend.